today's session. We are extremely happy to host all of you all for this very interesting conversation that we are about to start. When we talk about the Indian economy, we are actually slowly and gradually developing into a very mature market. When we talk about people investing in, when markets are going down, people are asking us, okay, where should we park our funds? Where should we look at investing rather than looking at redemption? But there are always concerns on volatility in the markets, or what could be the ideal asset allocation. With the rising cost in commodity, what should be the right investment proportion? What should be the allocation to equity, debt, or instead, in this case, we're talking about commodities. With silver also an option to buy digitally now, how should the diversification work between silver and gold in a portfolio? To answer a few of these concerns and questions, we today have Abhishek Singhal from Aditya Birla Sun Life Mutual Fund. Abhishek heads the passive business for them and has been responsible for setting up the entire plan and the roadmap and led the foundation in this area. With over 20 years of experience in asset management and investment advisory, he brings in a lot of value addition to both ABSL and to people listening into him. Personally, for me, every time I speak with Abhishek, there is something new and interesting I learn from him. Thanks, Abhishek, for being here today, and I'm happy to host you, and over to you.
My pleasure, Parthiv. Thank you so much for calling me here, and a very warm welcome and good evening to all the listeners herein. As Parthiv pointed out, markets and especially our investors and many folks who are advisors have become more and more mature. I mean, I remember about 10 years ago, 15 years ago, 20 years ago, in those days when we literally had to plead people to invest, when making money was, so to say, easy. Today, we've come to a situation where every drop, people are actually asking, is this the right time to enter? Should I top up? Should I double down? What should I do? But the one question that everybody is still grappling with is, how do I build a portfolio? Is my asset allocation right? Is the volatility going to kill me with the kind of returns that I'm getting, or should I be looking at something completely risk-free, get into 100% bonds? Because end of the day, with 8%, 9% sort of bonds now available, why do I need to take risk? Fact of the matter is that with risk comes return, with return comes risk. You have to have a balance of all. And the fact is that in a marketplace which is more inflationary, let me just quickly share some slides with you to put what I'm saying in a little perspective. Is my screen visible, Parthiv?
Yes, it is, Abhishek. If you can just put it on full screen, that'll be great.
I'll do that. And we are set. So, the going was pretty good till last year. I think we were recovering pretty well from COVID. News flow was very positive. Markets coming back. Liquidity was ample. RBI, along with the other central banks, was more supportive of growth. Every good piece of news that you could get, you were getting. And as you can see on the left-hand side of your screens, the charts were kind of pointing up in India and elsewhere in the world. We've taken NASDAQ as a simple analogy of the Western world or the developed markets. Though there were some bit of corrections, some bit of hiccups, which are pretty commonplace in a bull market, 8 to 10% is pretty decent. There was more and more money coming through, but something flipped. Something happened towards the later part of the calendar last year, and that's when the pain has started. As you can see, NASDAQ, the blue line here, has dropped by over 30-35%. This is one of the deepest cuts that NASDAQ has seen in many, many, many years. Maybe in the last 2-3 decades, it's the deepest one. Post the dot-com bubble bust in 2000, 2001. This is perhaps the sharpest one that has happened. Following that, Indian markets have also taken some bit of a pain. Now, what has happened really? As you can see from the right-hand side, our economy, along with the global economy, which is now more and more integrated with us, growth has started to slow down, and inflation has started to pick up its ugly head. Now, we saw a new news flow on inflation last year also. Inflation was being sticky, inflation was being a pain, but RBI was still persistent that, we need to push growth, we need to push growth, and here we are. Our CPI is already up at 6.1, which is outside of RBI's comfort zone. RBI's band was up to 6%. But elsewhere in the world, the largest economy in the world, US, Fed is very clear. Enough is enough. We need to start, cutting down the liquidity. We need to start tapering out again. So a new term in 2013, we heard the term called taper tantrum. This time around, it's quantitative tightening after quantitative easing. So subsequently, in every tranche, the Fed will start to either rise rates or will slow down on its purchases of liquidity from the market to infuse. Now, what has that resulted in? It's resulted in massive amount of volatility for both Western markets as well as Indian markets. But as you can see from here, the last 2 months have been pretty eventful. The biggest event which was about to unfold, which obviously is an event risk and nobody can model that into any sort of calculations, any sort of program or any sort of algo, is the geopolitical risk. When this tension broke out between Russia and Ukraine and the invasion started in late February, that's where you can see VIX. India VIX is basically an indicator for volatility in Indian equities. And whenever India VIX rises, equity markets in India always tumble, always. If VIX comes down, it's good for equities. If VIX goes up, it's bad for equities. Along with this, something else happened. And this is where I think more and more serious investors need to look up and take notice. Russia invading Ukraine is not merely a David versus Goliath or any other fancy name that we are talking about for this so-called dogfight. But the fact is, the world, the globalization, the era of globalization perhaps may be coming to an end. The Western world put Russia out of SWIFT. Along with it, China is silently supporting Russia. So a lot of conspiracy theories and enough and more on WhatsApp University. But the fact is, crude has picked up from 76 per barrel, $76 per barrel in early last year. It's already reached 110 per barrel and now 140 per barrel. It reached 146. It's come down, but there is more and more experts which are saying that supply lines have been broken. With Russia and Ukraine tensions going on, you are likely to see oil spike further. The demand for oil has gone beyond what has been budgeted by the oil producing and exporting countries. Now, every 10% rise in the price of crude results in 1 full percentage point in WPI. Our WPI, the wholesale price index, which is the core inflation, it has already gone to 13% and more. Now, what this really means? It really means that sooner or later, the central bank in India, RBI, will also have to follow suit along with Fed. Fed and ECB have already indicated massive amount of tightening. There is about 7 hikes of 25 bips each, 125 basis points in all for US and about 100 basis points for ECB. ECB is the Eurozone Commercial Bank, Central Bank. Now, the fact is that this amount of tightening basically means that emerging markets, including India, are going to be in a tight spot. What do you do? Every single time crisis happens, every single time the markets stumble, every single time a volatility patch comes in, we see precious metals comes to rescue. The last 5 to 7 years, you can see that almost every year, whenever a major event has happened, typically during that period, precious metals is what comes to rescue. And this is why it makes sense all over again. Precious metals, gold and silver, they tend to be hedged to uncertainty. Why? Because they are store of value. As was the previous comment by JP Morgan way back in early 1900s, gold is money, everything else is credit. Now, what does it mean? The fact is that all currencies in the world are pegged one way or another into precious metals, essentially gold, but then silver also is a subsidiary metal, and silver is also the most important base metal. It's the most important base metal, which happens to be a precious metal, has the highest amount of demand globally, and in all increasingly all sorts of applications, 5G, automobiles, green power, whatever that you name it, it's already there. So whenever there has been a crisis, precious metals has come to rescue. You can see the spikes in 2015 when the last time Fed rate was high. You can see the US-China trade war 2018-19. You can see, sometime in 2019, the Hong Kong tension. And in this year alone, for these 2 months, roughly 2.5 months, already, China, silver and gold have outperformed massively. Equity has delivered a flat return. All the gains have been wiped out. We are at practically zero. Silver is up 15%, gold is up 11%, and we believe that there is far more to go. The reason why we are talking about precious metals today, what we started out saying was markets have become more and more evolved. Investors have become more informed. What they are seeking today, are they seeking a binary result? Are they seeking only returns or only risk management? No, they need something in between. So this might look like a slightly complicated chart, but it's not, believe me. The red line is basically telling you that if you were to invest 100% of your portfolio in equity, and many of your portfolios might look like this, 100% investment in equity, your returns will be good, but it could go through a crisis also. Look at the years in the bottom table. Many a time, equity has actually delivered a deep cut also. It can really underperform everything else. How do you manage your portfolio? How do you manage portfolio liquidity? You can't even get out at this point in time. This is where standard portfolios or some bit of portfolio allocation to precious metals or safer assets like fixed income comes in. Fixed income, debt funds, they can cut down your risk, but they cut down your return also. So if you look at this table on the right hand side top, this is the average return of these asset classes over the last 15 odd years. This is data since 2006. We have taken it till December 2021. So it's about 15 years of data. For 15-year period, the average return equity generated was somewhere in the range of 15% per annum. For bonds, it was about 8% per annum. And along with it, it delivered a risk standard deviation of about 22% for equity and only about 3% for bond. So what does one do? You can't be on extremes. Either you could do a 50-50 or a 75-25 or a 65-35, which is where, that balanced fund as an asset class comes in. But today we've realized you've got something even better. You've got gold and you've got silver. If you see the data over this 15-year period, silver has delivered an average return of 14%, very near to Nifty. Gold has delivered about 13.5%, but with a risk of literally 30% lower or 35% lower, which is at about 16% per annum. So what we are suggesting is one should actually look at portfolios which have some bit of precious metals in. It should become a part of your asset allocation. What it does for you, and you can see portfolio 1 and portfolio 2, the one with 15% precious metals, the other with 10% precious metals. Your average return does not take too much of beating. It just comes out by about 1.5%. But your risk is down by about 40% or more. That's the point, ladies and gentlemen, that I'm making, that if you were to invest little bit of your portfolio in things like silver and gold for longer periods of time, your portfolios will become insulated from risk. If equities go down, gold and silver make up for it. If equity is going up, gold and silver continue to simmer at a certain rate. Whenever markets go through cycles, you have an opportunity of booking profits in one, getting into another. What drives their performance? Well, to be very frank, During bull periods, when growth is ample, the demand for jewelry and demand for industrial goods, base metals, is what drives their price. When inflation is high, and the current market is such where inflation is very, very high, cost is rising, and risk and uncertainty is high. In all these three periods, typically demand for precious metals comes for hedging. Their price is driven simply because the cost of mining these is high, and the investment demand also goes beyond normal for precious metals. So this is a period when institutional investors are already buying. This is a data point. What we are showing is the the AUM of top 10 precious metal funds. It has actually continuously been rising over the last some 2 or 3 quarters. Smart institutional investors are already seeing risk, which is the reason why they're starting to buy more and more of precious metals. Even in India, you look at asset allocation funds. The smart investors are already increasing their weight towards gold and silver. And as you can see from the chart in front of you on the right hand side, an average of 8.989% has already gone to about 15 to 16% in portfolio, and which is exactly what we are also recommending. At this point in time, you should have about 10 to 15% of your portfolio in things like silver and gold. It's already delivered return. It's already up 14-15%. Should you be investing even more? Yes. The charts in front of you are technical indicators. It's a ratio of equity to gold and equity to silver. Though the average line is not too sharp, you can see that the average of Nifty to gold is still quite high, which means there is still some more money to be made. In silver, the gap is still very, very high. Nifty is way overvalued in terms of silver, and which is the reason why we believe that from here, they are yet to fire completely. Of course, the last 2 months, given the Russian crisis, the Ukrainian crisis, precious metals have delivered some bit of return. But in times to come, for the rest of the year, and maybe for the next 2 to 3 year period, especially in a backdrop when inflation will remain sticky, when interest rates will rise further, you need to have protection in place. You need to have something which will gain in value, and which is silver and gold for you. How do you participate? Well, there are two routes to participate. Now, thanks to SEBI, you have both ETF as well as a fund which is available. They are both very, very easy ways of investing. You've got gold ETFs and silver ETFs, and you have a gold FOF and a silver FOF, which feeds into the same ETFs itself. The advantages are very, very simple. Anybody who has a demat account could potentially directly invest in the ETF. Anybody who does not have a demat account can easily come in the fund of fund. You have the advantage of doing an SWP, SIP, STP, anything that you want to do. All the typical facilities of mutual fund are available with fund of funds. Your investment amount can be as low as 1,000 rupees. You can invest directly into these assets through the ETF, wherein you get these holdings in your demat account. So the idea is simple. This is a time when risk is high in the market. This is a time when you need to build protection. This is a time to rebalance your portfolio, get your asset allocation right. At least 10 to 15% of your portfolio should be in precious metals. Most important at this point in time being silver. The advantage is that you can partner either through the ETF route or through the fund of fund route. Now, how do you do that? You can what are the advantages? Well, they are very, very liquid. You get 100% pure product here. There is no milavat. It's 24 karat that you get here. It's safe and secure. Why? It's kept in our vaults. We have insurance for it. You are not paying for it. There is no maintenance, no insurance cost that you have to pay. It's all paid for by the fund. There is no making charges. You try going out to the market, to the jeweler, you buy, gold bars or silver bars, you will end up paying 5 to 8% extra. Coming to a fund, you don't pay any of these making charges. and you don't have to store that at home. You don't have to worry about it. Everything else is being done by you. All you need to do is just simply sign a check. That's about it. I'll just pause here.